Well, it could be another wobbly session for stocks. We've been tracking the pre-market trade this morning. And interestingly enough, this week was the anniversary of the 1987 stock market crash. And it's worth noting that in that year, the S&P 500, like this year, had enjoyed quite a rally until late in the year, including the massive one-day drop in 1987. The year ended up being nearly a wash for investors. Now, stocks would have to take quite a tumble from here to make that true for the American market in 2023. But I want to bring in Ed Clissold, who serves as chief U.S. strategist for Ned Davis, for some more context on the markets. First of all, Ed, great to see you. Thanks for your time.
Yeah, thanks for having me.
So I'm not sure there's anybody that is anticipating a Black Monday type scenario unfolding here for the markets, but we have come off the highs, and those charts are starting to look pretty interesting when you pair them together. I know you've been looking at some of the comparisons between 2023 and 1987. What comes back to you?
Well, I think on the surface, there are several things that look similar. As you just stated, there's a big rally to start the year, and the typical third quarter pullback market breadth and percentage of stocks above moving averages deteriorated quite a bit. All the while, you had interest rates rising fairly sharply and the Fed becoming increasingly hawkish. So I think those things together, make one wonder if there's some more risk to the market. And then the real naysayers will say, well, then maybe we get a repeat of 1987. And
I guess let's do both sides. If you're in the, I guess let's say you're in the bearish camp, what would be the signs out there that there could be some stumbles in the short term?
Well, I think the bond market is a number one thing, John. With the 10-year in the U.S. getting above 5% this morning, the Fed discussing the idea of inflation may be tougher to get to a 2% target, so they're going to have to keep rates higher for longer. That could lead to increased borrowing costs for companies and hitting their earnings growth, which has been one of the things that have supported the market this year, is a really stronger than expected earnings. So those are some of the things that I think the investors need to be on the lookout for over the next few weeks.
Okay, and then if you're still in the bullish camp, because last time I checked, the S&P 500 is still looking at a double-digit percentage return this year, what would be the case on that front?
Well, yeah. So, earnings growth is doing well, and the economy actually has been quite resilient. And we're, in the U.S. economy is 2/3 consumer spending. So, if you're adding a few 100,000 jobs every month, it's going to be hard to get to recessionary levels. But I think we need to distinguish between the magnitude of what happened in 87 versus now. The S&P was up 39% at its peak year to date in 87. This year was a little bit less than 20%. And also the market breadth statistics, like percentage of stocks above their 200-day moving averages, that peaked in early 87, and even on the summer rally, that kept getting worse. This year, actually, we made new cycle highs on many breadth gauges. So there are quite a few differences underneath the surface that say that, an 87 type of event, other than the fact that it was a once in 100-year type of day, the setup isn't quite the same as maybe it first appears.
And I guess with all of this historical context, which you're always great to share with us, when you think about portfolio strategy right now, what's top of mind?
So the number one thing is to think about what kind of returns can I get in excess of cash. For the first time in over 15 years, cash is offering a real return, 5.5%, 6% in the U.S. So I think what investors are doing are saying, okay, I will invest in stocks, but I'll only invest in the ones that are going to give me really good earnings growth, far above 5%. Otherwise, why bother? And so I think that's our message right now. And as the economy continues to do well in the U.S., we do have a tactical overweight to energy and industrials, in addition to communication services, which have some companies that are secular growers.
Okay, and then I guess in terms of some of the other factors that you're watching out there, obviously you've got geopolitical uncertainty right now. How does that factor into the equation?
The way we look at it, Ned Davis Research, is that usually these geopolitical risks do not have long-term implications for the markets, but it does impact investor sentiment. I actually take it as a positive that with the events previous weekend in Gaza, the market actually rallied. That told me that there was already a lot of nervous buyers who had gotten out of the market. But clearly this has a ways to go. We'll have to see how it weighs on sentiment from here. And then the impact on oil will probably be the most direct impact on investors and the economy. And if oil were to climb back above $100 a barrel and stay there for a while, that could erode a pretty constructive consumer story in the U.S.